Welcome to Earnings Recap. Today we're covering Netflix's Q1 2025 earnings report.
That's right.
Our mission with this deep dive is really to cut through the jargon of their latest shareholder letter.
Yeah, get straight to the point.
Exactly. And extract the essential financial insights for you, the busy individual investor.
Mm-hmm.
We'll be focusing on the key numbers, revenue, net income, earnings per share, their growth compared to last year.
And what they're forecasting, their outlook.
And the outlook, definitely.
Yeah.
Okay, let's get into it.
All right. Well, it's noteworthy, I think, that Netflix has really come out of the gate strong in 2025.
A good start, they called it.
Yeah, a good start. Their first quarter performance, it shows that both their revenue and their profitability actually exceeded their own projections.
Oh, interesting. So better than they even expected.
Exactly. Which suggests, a real underlying strength in the business as we move through the year.
Absolutely. And the raw numbers, they tell a pretty compelling story, don't they? Revenue hit $10.543 billion.
Which is a solid jump from last year.
Yeah, a solid 13% increase from the $9.370 billion in Q1 2024.
And the operating income growth was even stronger.
Right. That jumped by 27% year over year, landing at $3.347 billion.
Right.
So what were the key drivers behind this outperformance?
Well, the shareholder letter, it points to a couple of things, really.
Right.
They saw slightly better than expected growth in both subscription numbers and the ad revenue.
The ad tier kicking in more?
Seems like it. Plus, the timing of certain expenses, it just worked out favorably for them this quarter.
Timing.
And if you think about their priorities for 2025, like improving content, growing ads, developing newer stuff like live programming.
Like those priorities they laid out.
It looks like these efforts are starting to pay off financially while they're still keeping an eye on, healthy overall growth.
Okay, let's dig a little deeper into that revenue growth.
Yeah.
You mentioned 13% year over year.
Mm-hmm.
But I also spotted a 12.5% figure in one of the tables. Just a slight difference, but what's behind that?
Yeah, that's a good catch. It often comes down to foreign currency fluctuations,
The FX impact.
Exactly. So the 12.5%, that's the reported revenue growth, what you actually see on the financial statements.
Got it.
But if you look at it on a foreign exchange neutral basis, basically, pretending exchange rates didn't change.
Right, apples to apples.
Their revenue would have actually grown by 16%. So the core drivers, like more members and higher prices, were strong.
But the currency headwinds held back the reported number a bit.
Precisely. Those gains were partially offset by unfavorable FX rates. And it's also important for you listening to remember, ad revenue growing, yes.
But still small relatively.
Very much so, compared to the subscription fees. That's still the main engine.
That distinction between reported and FX neutral growth, that's definitely key for understanding the sort of underlying business momentum.
For sure.
Now, let's look at the regions. How did things shake out geographically? It seemed like the UCAN region, US and Canada growth maybe cooled off a bit from Q4.
You're right about that. In Q1 25, UCAN revenue was $4.617 billion. That's up 9% year over year.
Okay, 9%. But didn't they have like 15% growth in Q4?
They did, yeah. So it is a step down. The company points to a few things here.
Like what?
Well, the ongoing impact of some price changes they made, the mix of plans people are choosing.
Right, people may be shifting plans.
And interestingly, they didn't have the ad revenue this quarter from those Christmas Day NFL games they had back in Q4.
Ah, that makes sense. A one-off boost in Q4.
Sort of, but they do say they expect UCAN revenue growth to pick back up to reaccelerate in Q2.
Okay, so maybe a temporary slowdown there. What about the other big international markets? EMEA, LATAM, APAC.
Yeah, looking at the breakdown there, EMEA, Europe, Middle East, Africa, that was pretty solid. 15% year-over-year growth.
$3.4 billion. Not bad.
Not bad at all. Latin America, or LATAM, that's on 8% increase, bringing in about $1.26 billion.
Okay.
And then APAC, the Asia-Pacific region, that was the star performer, really, up 23%.
Wow, 23%. Revenue there was $1.259 billion. So almost catching up to a LATAM in size.
Almost, yeah. And those varying growth rates, they likely reflect, different stages of market maturity, how well their local content is doing.
And just local economic factors too, I suppose.
Absolutely. All playing a role.
Okay, let's pivot to profitability. That operating income increase, 27%, that seems pretty significant. What does that tell us?
It really does, hitting $3.347 billion in Q1 operating income, up from $2.633 billion last year. I mean, that shows Netflix isn't just growing the top line, right?
They were managing costs better, too.
Exactly. They're becoming more efficient, and that pushed their operating margin up to 31.7% this quarter.
Up from 28.1% last year.
Yeah, so nearly a 3-point jump in margin year over year. That expanding margin, it's a really strong sign of improving profitability and, well, overall financial health.
And that improved profitability, that flows right down to the bottom line, doesn't it? Let's talk net income and, crucially for investors, earnings per share.
Precisely. Net income came in at $2.890 billion for Q1.
Which is up from what? $2.332 billion in Q1 last year.
That's right, a healthy jump. And for you, the individual investor, that translates into the EPS figure.
The earnings per share.
Yep. Diluted EPS for Q1 2025 was $6.61.
$6.61. How does that compare?
That's a big 25% increase compared to the $5.28 they reported back in Q1 2024.
25% growth in EPS. That's pretty strong. Underscores that profit growth per share.
Definitely a key metric showing value creation.
So we have a clear picture of Q1, strong performance. What are they saying about the rest of the year? Let's dive into the forward guidance.
Okay. So looking just ahead to Q2, the second quarter, they're forecasting revenue growth of 15%.
15%. And FX neutral.
FX neutral, they expect 17%, so still anticipating some currency headwinds there.
Okay.
And they're projecting a really robust operating margin for Q2 as well, 33%.
33% margin. Wow. Okay. And for the full year, 2025 overall.
For the full year, they're basically sticking to their previous guidance, reaffirming revenue between $43.5 billion and $44.5 billion.
And what's baked into that assumption?
That assumes, continued healthy member growth, the impact of higher prices filtering through.
The ad business.
And significantly, they expect ad revenue to roughly double this year compared to last.
Double? That's ambitious.
It is. Shows how much focus is there. They're also holding firm on their target operating margin for the full year, 29%.
Based on FX rates back in January.
Correct. Based on Jan 1st rates. Though, interestingly, they did note that at current FX rates, they're actually tracking a bit above the midpoint of that full-year revenue range.
So maybe some upside potential there if currency moves favorably or even just stays put.
Could be, yeah. Something to watch.
Beyond just the core financials, the shareholder letter also touched on some, key business developments. What stood out to you there?
Well, what stands out, I think, is their continued execution on those strategic growth areas we mentioned.
Right.
Like the launch of their own ad tech platform in the U.S. That happened April 1st.
That's a big step, moving that in-house.
Huge. It gives them more control, potentially better monetization, and they plan to roll it out to other ad markets, too.
Makes sense. And the live programming.
Yeah, that's clearly ramping up. They mentioned WWE Raw doing well. They've got that Taylor versus Serrano 3 boxing match coming up.
A big event.
And they snagged a second NFL Christmas Day game for this year.
Doubling down on the NFL games.
Seems like it. These things are all aimed at, boosting engagement, keeping people on the platform longer, and offering something different.
Diversifying beyond just on-demand series and films.
Exactly. Though they also make sure to highlight the regular content slate did well in Q1 too. Series like Adolescence, films like Back in Action.
Yeah.
They pulled in big audiences.
So the core content engine is still firing.
Still absolutely critical, yes.
Okay. Lastly, let's quickly touch on cash flow and capital structure. Always important indicators of financial stability, how they manage their money.
Absolutely. And they look pretty healthy there. In Q1, net cash from operations was strong, $2.789 billion.
And free cash flow.
Free cash flow was $2.661 billion. Also very solid.
And they reiterated the full year forecast.
They did. Still expecting approximately $8 billion in free cash flow for the full year 2025. That signals, continued confidence in their ability to generate serious cash.
What are they doing with that cash?
Well, during Q1, they were pretty active. They paid down $800 million in debt.
Deleveraging a bit?
Mm-hmm. And they bought back 3.7 million shares of their stock for about $3.5 billion.
Returning capital to shareholders.
Significant return, yeah. And they still have quite a bit left under their current share buyback authorization, about $13.6 billion.
So, plenty of firepower left for more buybacks if they choose.
Looks that way.
Okay, so, just to quickly wrap up for everyone listening, Netflix, a strong Q1 2025. They beat their own guidance on revenue and operating income.
Yep, good start to the year.
Healthy year-over-year growth across the board, really revenue, profits, EPS up 25%.
Solid growth.
And the outlook for Q2 and the full year seems positive. driven by, content pricing and that increasingly important ads business.
Plus the new stuff like live events.
Right. Continue to invest there.
So I guess this leaves an interesting thought for you as an investor to mull over.
Okay.
Given Netflix's clear pivot towards advertising revenue and this big push into live programming, how might these shifts, ultimately shape their long-term growth, and where do they fit in the ever-changing entertainment world?
Yeah. How does it change their competitive position long term? Good question to think about.